What's going on, everybody? Welcome to a capital hungry market analysis webinar. It is currently roughly 6:40 p.m. Eastern, Tuesday, November 7th. We're just going to be continuing from our previous market analysis webinar, where we have trade ideas and analysis playing out across the board amidst the poor market conditions. That's one thing we still have to understand and focus on, is that with the lack of economic data reports in focus, a lot of the major events priced in from the previous weeks, and no major escalations or de-escalations of the Middle Eastern tensions, overall market volume and volatility still remains subdued. So we're still seeing poor market conditions, but doesn't mean we can't have the analysis still continuing and some great trade ideas still playing out. Now, just to review from the last market analysis webinar, we were obviously identifying this area of exhaustion on gold, digging into that historical high point of the 2000s, and anticipated that for the new business month, we could easily be seeing some deeper price setups, especially if we remain below the 1975 area and 1972 key level. We were looking at this general range low area, digging into the 1960s, of retesting previous highs and retesting this area of interest where we saw more buyer volume accumulate in the market, leading to these higher highs being printed here. So even though we're showing those signs of exhaustion, you can see as we had that bearish move down with sellers in control on the intraday amidst lower volume and volatility and price setups for the new business month, we still showed signs of sellers exhausting with the failure to break this demand zone, and then some buy orders starting to be collected in this area as we still closed above on the daily candle, and this 4-hour candle engulfed the last 8 hours of bearish price action here. So it's quite interesting because that technical price action there tells me from a fundamental perspective that the overall lingering geopolitical tensions, the potential for escalations that these other Islamic countries might get involved to obviously back up Palestine against Israel, which would be poking the bear in terms of getting the US involved and so forth. Those lingering tensions, coupled with the Fed still having overall a dovish undertone previous FOMC, and the potential that we're still going to be getting some weaker US data reports going into the next weeks, is still keeping gold bullish above this demand zone. And when we're looking at areas of interest, you can see below this price sensitivity area, the next real area of interest is going into the previous highs into the 1930s. So now, if we're still holding above the 1960s here generally, whether it's just continuing with low volume and volatility, or whether we have Middle Eastern tensions escalate, then we could be seeing similar repetition in terms of even the volume and volatility conditions, where you can have aggressive bearish downside moves into that demand zone, but still overall just see gold price subdued at these highs. Not really seeing some clean, impulsive, one-sided moves, but still maintaining respect to that demand zone of showing buyers in control while chugging back into the same highs of the 1980s and 1990s. So that still looks like it's evident here and can take place here as long as we're holding above the 1960s. If I'd want to see any more downside on gold, we need to be breaking well below the 1960s, where that next area of interest is we do have a minor price sensitivity zone on the intraday, digging into the 1945s. But the next major area of interest is really going into the 1930s after that. Now you can see the same time we're seeing gold show some signs of sellers exhaustion, still holding that key price level. We also saw dollar start to show first signs of exhaustion of this pullback phase and correction we had to start out the week with rejecting the 105.6 area, right? So remember, that as we broke below this general range low and price point of interest on the intraday timeframes, which was induced by two stacking fundamental catalysts, one being the dovish undertoned FOMC sentiment, and then the second being the weaker jobs and PMI data to close off the week. You can see for this new weekly period, we were just seeing a correction of this larger bearish impulsive move, accumulating some more potential seller order flow into the new business month. And if we're still holding below here, we can still see dollar having deeper corrective phases before seeing buyers enter the market from lower demand zones, right? Especially if we don't have any new fear, uncertainty, or doubt from a global perspective. Now, there's two unique situations here. What do I mean by that? Well, when dollar's bearish, there's a situation where both dollar and gold can be bullish, right? If we have increasing geopolitical tensions in relation to the Middle Eastern conflict that's going on, that's a reason for both dollar to snap back in the range and just continue bullish and gold to be bullish. But if dollar remains relatively flat and we don't have Middle Eastern tensions escalating, right? Dollar being more bearish is just showing that the weaker US economic data from last week and the dovish undertoned FOMC is still holding some weight in terms of market sentiment. The dovish undertoned FOMC and the weaker US data, that's still bullish for gold and reasoning for, in terms of market sentiment, to show gold still holding this general demand zone, right? So just to show you guys a visual example, lingering geopolitical tensions of just not seeing any major fear, uncertainty, or doubt, but we're not seeing any resolution with the Middle Eastern conflict, plus the dovish undertoned FOMC and weaker US data can still keep gold elevated at these highs, with price action moving in a much slower and steadier fashion. So we'll mark that out in like blue here. Which would be very similar to what we were describing that took place here in poor market conditions. Right? So in blue, so in green, that's where you just be seeing some of the more impulsive moves, going to highs and probably printing some new highs as well. Now, that's just the main bias still from a technical and fundamental perspective. But We also want to understand what can potentially lead to us having some clean intraday candle closures below the 1960s and seeing larger correction. To put the CPI here, the CPI in here too. So doing this type of analysis, it's just good visual representation of how price can move and what would lead to price moving that way alongside the market conditions that would follow, right? So, for example, the situation in blue, if we don't have any major escalations of geopolitical tensions, but we also don't have any de-escalations either, just the lingering of these Middle Eastern tensions that can pop off at any moment can still keep gold demand higher at these prices, right? We still have the dovish undertoned FOMC where they're taking a very slow and steady approach, and that's keeping equities optimism and greed still more active there. We had the weaker US data regarding the jobs data. And if we have continued weaker US data, or even with the cooling CPI next week, it still factors for gold to remain bullish above the 1960s, but we're not going to really be expecting any major impulsive movement of like 300 pip hourly candles or continued moves to print new highs. We're going to expect some repetition like this of price still respecting this technical demand zone and having these aggressive wave formation in terms of digging back into the 1990s. What we would need to see for more impulsive price action of buyers in control and higher volume plays would be fresh escalations of Middle Eastern tensions, any new fresh fear, uncertainty, or doubt that the market can focus on and digest, such as more banking sector failures, continued weaker US data reports starting to highlight policy lag effects, declining CPI, having the markets hoping and pricing in rate cuts in a sooner fashion, which is still more bullish for gold. Those are factors either in singular fashion or, of course, in collective fashion that would lead to gold still respecting this demand zone technically and having more impulsive bullish price action, more than likely digging into printing new highs into the 2020s on the intraday. So that's still our main bias in understanding market conditions that would follow in those scenarios if we're still respecting that 1960s area roughly, right? Then in terms of our secondary bias, just to understand and have that knowledge, so if those events do happen, when you're looking at the newsroom or when you're looking at data reports coming out, if we're obviously looking at the newsroom, and let's just say, just in terms of talking, in terms of just creating a scenario so we can understand the situation better. If right now we're looking at the newsroom, in the next 5 minutes, a headline comes out that Israel confirms a ceasefire and will give opportunity for Hamas to release the hostages and they'll decrease the violence, obviously. Obviously, then from a technical perspective, we're not going to continue to look for gold buys as you're having de-escalations of the tensions. So that's going to decrease gold safe haven appeal, right? You're going to see more demand in the risk assets, less demand in gold during that period of time. So then we're going to be adapting to this downside move. But any type of ceasefire, any type of optimistic diplomatic progression, stronger US economic data, hawkish Fed interviews, higher US CPI showing the Feds need to keep rates up higher for longer, those are factors we need to keep an eye out for that both are a mix of reactive events and pre-planned scheduled events that can lead to gold breaking below the 1960s and having much larger corrections going into the 1930s. But I just want to talk about that on gold because yesterday we were talking about some of the technical repetition and identifying these key price points and understanding how gold can revisit demand or supply zones multiple times on an intraday perspective. Today, I just wanted to build on top of that, talking about those fundamental scenarios. So now, when these scenarios potentially pop up in the newsroom or when you're looking at the data results, your brain will already be programmed ready to say, okay, we already prepared for this. I know that this bad data report plus tensions escalating and gold still respecting this 1960s demand zone, we're going to be digging back into the 1990s. I'm going to be taking advantage of that from a intraday trading or scalping perspective, right? Everything else is still pretty standard. So we're still seeing dollar respecting our analysis where even though we had the pullback, we're clearly showing some signs of exhaustion on the pullback in the area we expected. Even if we dug a little bit higher to 105.9, we were still showing signs of exhaustion in that area. So now, even though we have less volume and volatility and poor market conditions, would like to slowly see this upside move getting faded out. Bear still in control, seeing those price setups we expected due to the lack of any major Middle Eastern tension escalations at the moment. And of course, still having, with us rejecting this area, it still shows in terms of market sentiment that the dovish undertoned FOMC and the weaker US data reports are still holding some weight. VIX is still relatively flat as we expected equities to still be holding some of that greedy optimism. So we can still see equities possibly coming to 34,300 before seeing signs of exhaustion or even into the 34,500s we were talking about. We did a good job ever since post FOMC to be adapting to the extended upside play, especially understanding market psychology of how it's just a lot easier for the stock market to be bullish rather than bearish when you understand how interconnected it is to global economies, corporations, profits, investments, and so forth. And dollar pairs are still respecting the pullback in terms of retesting previous highs, but just a very mixed day through the New York session with the lack of economic events. Like EURUSD still retested the previous highs, created a support and had a minor bounce, but nothing major yet. So we don't really see full dollar weakness in effect just yet, but we're still sticking to the same analysis from the last market update webinar. Same thing with GJ. GJ could still easily go to, like, don't worry about this subjective trend line. A line on a chart does not highlight structure. That's just for visual purposes. What highlights structure is prices. We could still easily see GJ going to retest the previous highs, right? Where we had these highs printed, a pullback phase to accumulate more buyer order flow, and then continuation moves into these higher highs. If we break below this price sensitivity area, we could easily still be seeing this corrective phase being respected, which it still is, and going into the 184.2s, 184s, before seeing a very similar sequence of events of buyers entering from lower demand zones before continuing the intraday trend. So right now, all we have to understand is very similar to this situation, like we were talking about in reviewing during the New York Zoom, when these highs were printed by buyers. We're still, and this is just a subjective trend line, but we're still respecting that corrective structure, which is validated still holding below 185s in this situation. That's still looking a lot more high probability, which is still from our previous market analysis webinar. Now, obviously, the one thing we just have to keep an eye out for is if you do have any escalations of these geopolitical tensions from a reactive standpoint, that's going to lead to much more aggressive event-induced pullbacks. That's probably going to dig a lot deeper than just retesting the previous high. It'll probably come to this exact same demand zone again into like 183.2s before continuing higher. Zippo, what are you doing in here? Go go watch the educational webinar. A guy from New York session who just joined. Oh, the New York session was fun, man. So yeah, it would lead to a larger event-induced pullback from that reactive standpoint, where you'd have a deeper pullback than just retesting the previous highs. You'd come to this same technical demand zone again, where we saw buyer order flow clearly accumulate before extending into these higher highs. And on the flip side, though, if we have de-escalations in a ceasefire, that's just more reasoning for buyers to like maybe get a quick liquidity grab or just start seeing impulsive moves back to the highs. Right now, the geopolitical tensions are just lingering. A lot of the events have been priced in, and it's more of just a waiting game on monitoring headlines. So now, before we jump into the individual analysis and trade ideas, we just want to see what we have on the schedule, but it's still looking generally quiet. So overnight through the London session hours, we just have some German inflation data, which isn't expected to show a major change, but if it's still elevated, it just shows that the ECB still needs to keep rates up higher for longer. And that can still keep some demand in euro, especially if dollar remains softer. And then at 5 a.m. Eastern, we have some retail sales. That can lead to a little bit of mixed indecision on euro, just because Eurozone is just dog shit. In terms of their economic activity, economic health, it's just not in a good position at all. That's one of the main reasons that they haven't raised interest rates into a more restrictive territory stance, like into 5% plus, and they're just hovering around 3% right now, even though inflation is still pretty elevated in the Eurozone, right? The main reason is if they were to raise rates continuously into 5% range, it would just hold way too much negative impact on their economic activity and business activity. They would probably break their economy if they did that. You know what I mean? So yeah, like the lab's saying, the US economy and Eurozone economy are completely different. The US economy is way more resilient. The Eurozone and UK economies, the Eurozone economy is the most fragile. UK economy is a lot weaker than US. If we were to put it in the top three, and just between those three, be US at the top, then the UK, and then Eurozone last. Eurozone's pretty fragile. But anyways, so that can lead to a little bit of indecision as they're still expecting some weaker macro data, which is primarily usually what's in more investor focus with the year over year, expected to go to minus 3.1%. And then during the North American trading session, nothing's really going on, just some routine treasury auctions there, note auctions, and then wholesale inventories isn't important at all. Canada building permits data isn't important at all. From a central banking and political perspective, oh, we do got Powell tomorrow morning. So at least that should bring some volume and volatility. But more than likely, he's just going to repeat what was said at FOMC, especially what he said towards like the end of his speech of taking a very slow and steady approach. U.S. economy still remaining very resilient. Labor market not showing major signs of cooling yet. Inflation still being sticky, but in a much better position than the previous year. So I still think he's going to be relatively dovish undertoned, more of a priced in sentiment there. But yeah, Fed speakers are scattered out into the afternoon. So now, in terms of trade ideas, when we're looking at gold here and just individual analysis, you can see we've clearly shown those signs of exhaustion into the 2000s, which is just a very important historical price on gold. But we're still seeing very similar sequence of events to what we saw with the banking sector failures, right? This was when we had more fear, uncertainty, and doubt with the Silicon Valley Bank collapse and Credit Suisse collapse. And this was obviously the Middle Eastern tensions. You can even see the bullish runs topped off and started showing signs of exhaustion at pretty similar prices. You can even see that we saw pretty similar price reactions where you accumulated order flow as well, just in a short-lived manner, right? Now here, what can fake a lot of people out who are trading technicals only, and they're just looking at pattern formations and not looking at both sides of the market remaining objective, is that you can see these very aggressive bearish candle moves or aggressive downside moves there in general on the intraday that can start to make you think there's going to be a reversal, right? We were talking about that in detail the last couple of webinars. A lot of people can be expecting that now as well. But what we also have to look at is that the general trend is still very bullish here. And very similar to this situation, we still saw that from the previous highs here, that we were holding above that general price point of interest. And we're having that similar situation taking place still here at the 1960s. So if we don't break below the 1960s, we don't want to get caught like some of these sellers that are expecting a reversal, where it just ends up accumulating more order flow to still just be digging back into the range highs into the 1990s, right? Because it's very interesting. It's not interesting. I just mean it's more surgical, right? It's very surgical how the algorithms move, where as aggressive as the bearish price action was, as consistent as the bearish candles were, still conveniently digging into that general demand zone, we still failed to break and had the daily candle close higher. It's still looking like a similar sequence of events to here, even as you had an aggressive move, but the candle body still closed higher. And we can see that taking place here. Now, because we have lower volume and volatility and generally poor market conditions, we could easily still be sweeping into this area before starting to see more buyer order flow accumulate, digging into the 1980s. And I'd only be comfortable with sells breaking well below these candle body lows. So when I'm looking at gold on the intraday time frames, alongside the key levels as well, I'm personally only confident really seeing some consistent sells breaking well below the 1960s. with some of those fundamental confirms we're talking about. Otherwise, if we revisit the 60s but fail to break and come and hold above 65 or break above 72 and 76, it's still our original analysis in play and continuations from the previous market update webinar. With GJ, we're still in this corrective fashion where if we break below 184.8, we could still see those short-term squeezes, especially into the new business month, of retesting into these previous highs at roughly around 184.2 and 184 before really starting to see buyers come into the market from those lower demanded price points. Otherwise, if I want to be jumping in buys from current prices, I need to be breaking above this last exhaustion and rejection point above 185.2, which we're at least expecting ranges to at least revisit the previous highs, which is still like a 60, 80 pip move. With our dollar pairs, still looking for some of these continuation plays. If dollar can't break back above the range and cancels out some of that pullback move, at these three prices, only see safe sells below these previous highs, canceling out the upside from the data report plays from last week and breaking below 1.065 for key level. GBPUSD is a similar idea. Only see sales below 1.224. Now, UCAD had a very aggressive rebound where we were just expecting a pullback phase before continuing lower. But it's because oil has remained relatively flat as Middle Eastern tensions have simmered down. And we've had pretty aggressive correction on oil here. Like we're still very like macro bullish on oil, but you can just see from those general highs that we peaked into $90 a barrel, it looks like oil is going to be digging back into like $70 a barrel if we don't have any escalations of geopolitical tensions. And that still keeps the Canadian dollar a lot softer. So our analysis got invalidated there on USDCAD, but I'm still not fully confident that buyers are in control. If dollar still remains flat there, we could easily still come and see this downside move into 374 before seeing bounces again. Otherwise, we need to be breaking above the 3.8s and 3.88 area. Last but not least is equities, which is still looking like the optimistic greed is holding some weight here. And that we could still at least be digging into key level 34,500s, especially if we're holding above this price point roughly at 34K. We don't really have any major fear, uncertainty, or doubt. We don't really have any important US data reports in focus this week. We don't really have any major strength in the US dollar still. Even if we hold above 34K or break above current prices, we could still easily be retesting into this general price zone. Around 34,500s before starting to see buyers exiting positions and short sellers coming into play. We can still see that global equities are still holding those bounces from the lows, just starting to range a little bit on the intraday, but that's just due to the less volume and volatility. VIX is still generally flat against the S&P 500, but it just shows you about equities overall there. So then when we're looking at US 30 on the intraday time frames, I still see these buy plays before looking for exhaustion into the 34 500s. Adapt accordingly if there's any new fear, uncertainty, or doubt, but it looks like tensions have simmered down for now. I still see some banking sector failures to come into 2024, just amidst the tighter financial conditions. And as global economies will be weaker, that liquidity will be sucked dry there. But for now, everything's pretty quiet.